afternoon, everybody, and welcome to SALT iConnections Asia and our panel for the ongoing search for Asia's alpha generators. My name is Michael Denoon-Slater, and I look after Asia Pacific for iConnections, and I'm delighted to welcome you all here. And if I might take a wee moment just to acknowledge the work of all the staff in the background, and if you've got time, please do go to the information desk and say hello to Kira, Nancy, Jovan, Mandy, Grace, who've done so much hard work, and they'd love to see you there. Now, I first came out to Asia in 1991, and I've been intimately acquainted and associated with the region ever since. In fact, I used to think I was the most passionate advocate for Asia until I met Wei Lu, who's completely eclipsed me in a good way. So I'm very excited to share this panel with what I regard as the A-team of the Asia Heavy Hitter League. And now we've got a lot to go through in the next 40 minutes. So may I first start off by inviting the panel to introduce themselves and just give a wee bit of background about their firms. And Mike, if you can kick us off.
Yeah, thanks, Mike. And thanks to iConnections for myself and also my Thai collection. It's been a long 4 years. It's been a long time since I've been in person to see a lot of these investors. And I've been in Asia now 21 years. I came out with Morgan Stanley in capital markets, then invested for a family office in Hong Kong, joined Blackstone, helped them start seeding, and worked with Blackstone New York for a couple of years before coming back to Asia 10 years ago. And we started HS Group with TPG Capital and a circle of Asian family offices with a mission to find the best emerging alternative managers around the region and back them with long-term capital. So we invest through a private equity vehicle. We've deployed $2 billion thus far, and these are mainly startups. So experienced PMs, teams, but new businesses, and we've grown them from scratch to $8 billion over the last 9 years. Very excited to be with you all and chat with my esteemed peers.
Wei.
Sure. My name is Wei. I'm the partner at the Clocktower Group. I've been here for 13 years with the firm, and I'm very lucky to be the only foreign partners with a shop based in Los Angeles. And we are managing assets mainly for the sovereign wealth funds, the pensions, endowment, and very large family office. And the way we manage assets for them is normally think about what is going to be interesting to generate alpha for the next generations. For example, there's 4 areas we are really focused on these days. Number one, we focus on global macro seeding, but with a geopolitical angle, so where we try to abstract alpha from. Number two is that we see the disruption of the traditional finance by the technology. So we have a venture focus on fintech. Number three, we think that the world is going to be racing to zero in these CAPEX delayed situations in the commodity super cycle. That's why we have a climate and sustainability oriented business focused on that. And then lastly, as everybody's turning away from China, we are actually trying to be contrarians. So we have a China business.
My name is Charmaine Chin. I work at Blackstone Alternative Asset Management. We're the largest global discretionary investor in hedge funds. We have about 80 billion in assets under management. And I head our Asia manager selection team from Singapore. I have about 15 years of experience investing in alternatives.
Jan.
Hello, everyone. I'm with CBP Investments, a managing director in the external portfolio management group. I oversee the emerging manager program globally for the group, which focuses on hedge fund investing and seeding and accelerating new hedge fund managers. The program has been going since 2016, and over that time frame, we have worked with 20 different managers and invested approximately $6 billion across hedge fund strategies globally in emerging managers.
Brilliant. Thank you very much. Right, let's kick off. Your starter question for 10. What do you look for in a manager? Mike, if we start off with you.
Yeah, so we've got quite a lot of data points at HS. We've seeded 15 teams over the past 9 years. And prior to that at Blackstone, we were deploying capital from '07 onwards. So we had a cohort that came through the Lehman crisis. I've got tons of respect for seeders like Julian Robertson, and we're different in that we look at different strategies. So we think the underlying drivers of success are actually quite common, whether you're looking at someone in Japan or someone in London, whether it's a low net manager or someone that's a bit punchier. And I think it's drive. And you really, I think, look at the industry today that's been in hedge funds shrinking, through so much turmoil. And what's really exciting for us is the drive present in the founders that are starting hedge funds in 2023, or the last couple of years through COVID. It's clear that they've had, if they're good, many, many opportunities to cross over to the private world, work for 𝐬𝐮𝐬𝐫 or Ken Griffin, and instead they've decided to go an independent route, seeking to generate the best 30-year IRR. And when you look at the success in my field, seeding, it's really through duration. It's through surviving the cycles, and I really come down to that factor of drive as the best explanatory variable. We like to see lots of evidence of this drive before we'll invest. So, emerging manager is a bit of a misnomer in terms of age of the founders of the teams that we work with. It tends to be a little bit higher than the industry average. Folks in their 40s, they've seen a couple of cycles, and then outside the office, in the game of life, they've had a lot of seasoning as well, overcoming adversity, having that drive to, bring the passion to their work and, people around them. So yeah, I would say there's a lot of things that are very, very important as well. There's, I think, quite a lot more testing of skill in these markets, particularly in Asia, where the tail's been wagging the dog. It's geopolitics in Washington or Ukraine driving, liquidity and market volatility. But yeah, I'd say the drive present in this generation is the really exciting thing.
Thank you. Wei, what's your thoughts?
I think you guys all the expertise in the manager research spaces, and you're going to talk a lot of how to evaluate a good manager. I just want to mention one point, is that in current environment, with a 5% risk-free rates, it's going to be extremely hard as the bar to allocate to the hedge fund managers is going to increase dramatically.
So
on
true.
the other side, the alpha gets squeezed in many of the crowded areas, okay? As people all chasing for carry, chasing for yield, etc. So what we are trying to provide of the values or thinking differentiate out of the box is that what are the areas potentially could be good as a satellite positions for our clients, as well as we extend it as the analyst teams for our institutional investors, so that they will be looking for more niche strategy, differentiated style, nimble, orthogonal return profiles. Very easy to say, but very hard to do, okay?
Charmaine.
I mean, the way we think about it is that talent is everywhere. I always tell my team, every manager is going to be impressive when you first meet with them. But what we're trying to do is understand which manager has a sustainable and repeatable edge over the other managers. And in order to understand that, we have to meet everybody in the market. We have to understand how each manager interacts with the other in the market and which of them have an edge. And so we meet hundreds and thousands of managers. We have over 100 investment professionals on our team. And we really want to understand that full universe.
Mike, you touched upon emerging managers just now. Jan, what's the outlook for new emerging manager launches? And secondly, your thoughts on platforms versus standalone launches?
Sure. I think in terms of the outlook, Right now is a probably more difficult time to launch as an independent manager, just given the very high competition for talent. And it's not so easy to fundraise and reach scale. And I think unless you are in a very small category of very high pedigree, very high profile launches where everybody knows who you are and you can immediately attract billions of dollars, it's generally going to take people much longer to actually get to scale. And I think that's actually where it is helpful to partner with a strategic investor at the beginning. In our case, we can provide a very long duration of capital and size of capital. And we think that by partnering with an investor like us, a manager is more likely to be able to scale quicker, as well as have a higher quality team and be able to actually make higher returns and increase the value of their business versus if they had to do it on a standalone basis. As it relates to platforms, I think it's an interesting environment right now. I'll focus actually on maybe some of the pros and some of the helpful factors from platforms for seeding and investing in emerging managers. I mean, there's a couple of aspects. So one is that we do see quite a few PMs come out of the platforms once they've been there for a while and they're ready to start their own business. In those cases, they have a lot of experience taking risk, managing teams. They often have track records as well. So it makes it a bit easier to evaluate. So that does create some opportunities as well. In other cases, we're able to work with new platforms, potentially even seed new platforms in cases where that makes sense. And then lastly, there are cases where we can partner with platforms on working with some of their spin-outs or some of the managers that they are invested with, and we can invest alongside and access talent that we wouldn't otherwise be able to.
Charmaine, how does that resonate with what you're seeing?
Yeah, just on your point on platforms, I think platforms are looking for a very specific type of portfolio manager, right? They're looking for managers that can generate very low volatility returns under very tight risk framework, and then they can lever that strategy. And not every portfolio manager and every strategy will fit well on a platform. So I do think that that's an opportunity for someone like us to come in and be able to seed or anchor some of these managers that are not necessarily good fits for those platforms. While the platforms themselves are clearly growing, I think they make up, the last figure I saw was just under 400 billion of a 4 trillion industry, but they're growing much faster than the rest of the industry. And so I think that's a trend that has been going on the last 2 years and probably will occur for some time.
Thank you. Again, just another follow-up there. Multi-strats, Mike. They seem to be dominating the industry at the moment. What's your views on that trend?
Sorry, could you repeat?
Multi-strats seem to be dominating the industry at the minute. What's your view on that trend?
They've expanded really rapidly over the last 5-6 years in Asia. So, in our backyard here, it's definitely had a positive impact on the training of the talent pool. You'll look at more teams outside of just vanilla equity long-short, and they're running much larger books than they were. It's a double-edged sword. You look at Japan, so the high watermark on Japan's hedge fund industry was 2006, and the platforms have trained an entire generation of PMs in Tokyo within very, very tight risk sandboxes. I think those strategies make less sense in a higher interest rate world. And I wonder if the platforms corrupt some of the talent in the rest of the region. Probably not. Most of Asia does not fit well within a very, very tight risk sandbox. So I'd say great training ground for junior people. Okay, very interesting difference when you think about platforms in Asia versus the US. Not clear to me why you would leave a 0.72 in New York and start the 503rd US TMT equity long-short fund. Here, okay, you can leave a platform, and if event-driven is your thing, you can literally be manager number 4, right? Multi-strat, the way 𝐻𝐢𝐬𝐿, Highbridge, York
which they've all gone away, right? And some of the replacements have had high volatility during the COVID period. I mean, that's a vacuum. Consultants love all weather, all season, 𝐋𝐢𝐬𝐿, Asia style, multi-strat, and there's virtually nobody to choose from today. So, if that's your thing, you can kind of pioneer that space for, the next phase. And so, yeah, we've got a ton of people leaving platforms. They want to be, masters of their own destiny, and I don't think it's irrational with so little competition.
Thank you. Jan, how does that fit in with what you're here seeing?
Sorry, can you ask again? Yeah, what's the question?
Multi-strats,
Yeah.
the theme.
Well, I think multi-strats, I mean, it'll be interesting to see actually how they do over the next year, because it's been a one-way kind of train, and they've done extremely well over the last 5 years. But I think given how many platforms now there are out there, and the competition for talent, and I think there will probably be differentiation and even potentially some amount of consolidation among the platforms, which actually may create more opportunities for all of us in terms of being able to seed managers that come out of there, or that somehow get left out, or maybe they don't fit on a platform, like kind of what they were saying. So I think it's an evolving space. It will be interesting to see what happens going forward.
Thank you. One of the big themes, well, the big pressures managers and allocators alike are facing in Asia at the minute, talent pool, retention, and actual recruitment. Charmaine, how is this affecting your investment decisions?
I think it's along the lines of what we were saying earlier, right? There is more and more talent, I would say, in Asia. We're seeing, spin-outs of first-generation and second-generation funds in Asia that are very interesting. But there is a war for talent, particularly because there's a growth of platforms, global platforms, regional platforms, and they are also looking for PMs. But because they're looking for a certain type of PM, I think depending on the strategy the PM runs, there's differing demand there. I think
thank you. Wade, are you experiencing much of an issue with the talent pool, retention, and recruitment?
Definitely, right. That's like the common challenge we all facing today. It's just like you have to be thinking ahead on what is, be just like know those person earlier, right? To the relationships.
Great, thank you. You very kindly forwarded a white paper on China. I think it came out last year, and I must say I enjoyed it so much I read it twice, and I never said that about a white paper before. And I think with China, and that's obviously, you can't talk about Asia without talking about China, everyone was expecting the post-COVID bounce this year, and that hasn't materialized. We're really keen to hear your thoughts on China, and is it still an investable space? And if so, how do you invest in that area? Wei.
All right. I think you asked several questions in here. I try to answer it in a more logical order, and to think as a framework as we think about like the investable or uninvestable, because you cannot just look at that, okay, it's not or yes, right? I think one of the indicators we should be really looking for right now to answer these questions, it is China able to transfer into an innovative-led economies from growth China, which is soft technology oriented, into strategic China, which is hard technology oriented. I can elaborate a bit more about this one. But regardless, we all know there are still lots of well-known risk as we invest in it. Just like any market in the world. As such, the real questions, Michael, I think we all should ask ourselves, it is not whether China is investable or not, but how should the investor really mitigate of the risk while continue trying to harvest some of the opportunities in China. So I think I have 3 suggestions in here. Number 1, increase the bar as we invest in there, particularly on illiquidity risk premiums, which ties with the private side. Number two, try to separate China from your assets allocation bucket. Because China is neither a developed countries nor emerging countries, to be honest. It's neither or. So you have to separate of that to think it by itself. So in this way, you will know how much risk you're exposed to. Number three, pay close attention on structures, approaches, how do you access it, the terms, the liquidities, the transparency, fee alignment. Because in the past, when the beta is good, it was the nominal GDPs, people just feel fine. Now, you should reconsider of that. Then, as you mentioned, okay, what is the opportunity set right now on China? I don't want to take too much airtime, to be honest. I will just give you one example, okay? What I call this one in our white paper is China's technologies globalization. This is very similar to the 1970s of Japan. As China is moving away from the China-American model into the German and Japan models, where made in China is now hard to sell around the world rather than good sales. But there's a lot of access capacities in the new energy sectors, for example, EVs, battery storage, solars as well. So what they're doing right now, rather than export of the products, that was the old game 10 years ago, they are trying to export of capacity. That's what we see the opportunities. So you are investing in the Chinese companies are not investing in China anymore. You are actually investing in the Chinese companies' technology with global presence of that. I'll pause in here to save everybody to have some thoughts for that.
Thank you. Mike, have you anything to add to that?
So we take a long-term view. I think in China, taking a really long-term view is just going to be hard, right? I think that has obvious implications for venture and private equity. And then with hedge funds, we see a lot more applicability for pan-Asia funds. That's really come back, and that's probably the area for HS Group partners that's been most in demand. So a strategy where you don't have to be involved in China all the time. We've been on the margin adding to idiosyncratic, very, very oversold opportunities like DiDi Global ride sharing, half the market cap's in cash. They announced on Monday $1 billion buyback. They're very, very keen to relist in Hong Kong. It's on the pink sheets, nobody owns it. And this is a company that through COVID continued to have 80% market share even when the government banned their app. You go to Beijing, Shanghai today, it's indispensable for mobility. I think if you go to Shanghai today, you might have a similar interesting experience like I did 3 weeks ago. One, the hotels are astonishingly cheap. I'm talking like Andaz, Xintiandi, a quarter of the price of a night at the Andaz Tokyo, right? Local managers will tell you there's a lot of opportunity, and getting proper advice is difficult. Raising capital, they're actually thinking more about raising money onshore. There's a lot of capital that's obviously trapped within China. And then on the way to the airport, you might have a taxi driver like I had who asks what you're involved in. You say finance, terrible industry, but you might want to look at India. That literally happened to me 3 weeks ago. So, look through the cycles, right? But I think we have to be cognizant long-term to where China should be. Our mental model is it's just as messy as the US, but just as deep and at times just as interesting. It can be a quant perspective, a commodity perspective. So we look at Asia holistically, and some of the more interesting opportunities near term we think are in areas that have been in China's shadow, like parts of Japan, parts of the Southeast Asia story. So, yeah.
Charmaine, have you anything you want to contribute?
Sure. I mean, China's the second largest economy in the world. It's a very large alpha pool. You can't ignore it. I mean, there's a great statistic where if you look at the returns of MSCI China over the last 30 years, it's actually annualized at less than 1%. But if you look at active managers in that region, they've made multiples of their money over that period. So I think there is a lot of alpha to be discovered there. I mean, for us, we have investments across Asia, in China. We've been investing there since 2006. We're very committed to our presence in the region, and we've been growing it.
Thank you. There's been a lot of focus on the China property market, and one thing that's been winding me up, I don't know about you guys, but the difference in perception in the Western media and in local Asian media, especially if you're watching Fox News. How bad is the property market in China, and how much longer will it play out for? Jan, you're based in London. What's your thoughts on how the media portray Asia in the West?
I mean, I think I'll take a manager approach to this question. I think there's probably going to be a lot of opportunities just more generally in terms of more dispersion and more differentiation among different companies and industries, whether it's in China or Asia more generally. And therefore, I think while some sectors like property might be challenged, there could be other sectors that are doing well. There could be companies within the sector that are doing better than others, and actually I think that will create more alpha opportunities for active management, whether it's in equities or credit or macro. So actually, I think if you take more of a alpha, market neutral kind of approach, which is the way that we look at the investment landscape, then you could say that it's actually positive for the opportunity set in a way. Of course, there will be risks that we have to watch out for in terms of the geopolitical issues and making sure that capital is protected and so forth. But overall, I don't think it's entirely negative story.
Fair enough. Wei, what's your thoughts?
Well, as to be honest to yourself, right? I think the situation in the property market is bad by all dimensions. Like investments is collapsed, land sales is down, and most important, the property sales have shown no sign of the recovery of that, right? And so we agree that it's going to be a structured downward trend. And so a more important questions I think we suggest our clients be thinking about, it is how Beijing would be able to stabilize the domestic credit growth. I mean, the structural weakness of the property market, take that as a given, right? That should be the question we really think about, like the structural reforms, the regime shifts of that. Understand that Beijing has surging really lots of credit in the manufacturing sectors, including the 1 trillion RMB stimulus last week. And but on the other side is that the size of the new economy is still too small to really be able to reverse of this kind of macro management situations of that. So for us, we think that eventually Beijing has to leverage up the central government balance sheet, which is still very healthy compared with the local or the household at extremely low levels for the central government balance sheets. And to be able to engineer to a new cycles of that. Give that willingness, which is another indicator. So people ask, hey, what should I look at, right, for the problem? That is a clear indicator people should look at. It's a central government balance sheet expansions to stimulus on the consumers as a part of the credit cycles, then they potentially be able to turn around the ship.
Wonderful, thank you. We've talked a lot about China. What about the rest of the region? What is getting you excited, and are you looking elsewhere? Mike?
Yeah, so I'm going to go with Japan rates. Japan really hasn't had much of a bond market because the government has been buying back over 50% of the issuance for a better part of a decade. And, the finance industry, to kind of pick up on this Shanghai taxi driver, I mean, it has not attracted the best graduates since probably 1989, right, in Japan. If you're a top graduate from Keio or Tokyo University, you've been working for maybe an internet company or engineering firm. So there's a real dearth of talent. I like it because the few players that know that market have a lot of room to generate alpha. It's not very competitive. There's a lot of tourist money now going into Japan because of the regime change of the Bank of Japan policy, expectation for more inflation. Whether that's right or wrong, the locals understand the life insurers, the local dealers, their mentality, which is much more patient. And if you think about a Capula, 25 billion today, owned by Petershill, sold to AMG, super resilient, durable business. Chinese guy, Japanese guy founded it late 90s out of JP Morgan. That's a very, very scalable strategy. And coming back to Japan is the third largest bond market in the world. So lots of inefficiency, relevant TAM. And then from the demand side, I think a lot of us are looking at lower correlation strategies going forward. So here's a liquid underlying. It kind of delivers alpha at its own pace. So yeah, that to me is really, really interesting. And look around the world, how many people have pitched you, Japan rates with more than a couple of years track record trading that market, right? There's very, very few people that have that expertise.
Thank you. Charmaine, how does that fit in with what you're looking at?
Yeah, Japan's definitely interesting for us as well. I mean, it's a very deep and liquid market. It's a great market for longs and also a great market for shorts. You have thousands of listed companies, most of which are uncovered by the sell side. So there is a lot of inefficiency. And you have a market that's where, just like the US, large cap stocks have done very well. The US is driven by the Magnificent Seven, right? In Japan, you look at the topics, it's up over 20% this year. You look at the Mothers Index, which is their small to mid cap index, it's actually down on the year. So there is a lot of dispersion in that market and a lot of opportunities for managers to make money. So that's definitely one area. When we look at other managers that are focused on Taiwan or Korea, very flow-driven markets where the equity markets are driven by a couple of large stocks. Sometimes retail is a big portion of what drives that market too. And so you've got the rise of meme stocks in Korea, which has been both an opportunity for managers, but also a landmine. So it's something that we find very interesting.
Thank you. Jan, are you getting excited about the peripheral countries, Japan and India?
Yeah, we look at those very much as part of our global approach and looking for the best opportunities and finding alpha in every place where we can. I think one factor for us when selecting managers, whether it's working with established managers or on the emerging side, is scalability and ability to invest a lot of capital and sort of scale the alpha production. And I think sometimes when you look at single country mandates, that can be a bit more challenging, not in all cases. So we often look to access those opportunities through either multi-strategy funds or pan-Asia funds or multi-asset funds in Asia. But that being said, we also do have some India specialists, for example, focusing on market neutral in strategies in India, which is pretty hard to find, but there are some out there, and we've had some dedicated Japan mandates as well. But yeah, we look to access those markets as well through co-investments. We have a very active co-investments business where we can work with our managers to size up their best ideas, working with the manager. Sometimes we do country-specific themes or carve-outs as part of that program. And then we have also seeded and accelerated both platforms and multi-strategy kind of managers based in Asia who focus on sometimes a few countries, sometimes one country. So yeah, we've been doing it all.
Well, you've been busy. Thank you for that. It's a big week in the US. President Biden and President Xi are meeting today, and we've got potential government shutdown on the cards. What other macro headwinds are you anticipating that could impact the region in the coming year? Wei, you can kick us off with this one.
That's a tricky question. And I get asked many, many times, to be honest with you. I think largely speaking that the geopolitical risk has been significantly reduced very recently as China delivered Olive Branch to the US, and Biden tried to capture of that for various of reasons, including of the elections next year, right? So for us, as we think about like the ways we think about how this kind of we shape up the portfolios in this very geopolitical tricky environment, we think that both Beijing and Washington try to stabilize the relationships at this point. And lots of people asking of us about the upcoming Taiwanese election next year as well, but I think that even with the DPP is going to be highly likely to win, but it's not going to be a big event. And actually, we have a contrarian view, is that if there's any Chinese or Taiwanese risk assets get sold off because of the market concerns, that's actually the time to buy. That's why we call this one the geopolitical alpha, right by my partners, Marco Papic. And basically his point is that the framework to think about the geopolitical risk is not what you wish, what you like, what you think, but based on the constraints. Can you? That is what's really going on.
Thank you. Charmaine, what's keeping you up at night? And don't say jet lag.
I don't have that excuse. I'm based in Singapore. I would say, we just want to make sure that we're constantly generating strong returns for our investors, right? I think, as someone else mentioned, with cash returning what it is, we have to make sure that we deliver a right tail for our investors, and we're always looking for managers that can do that. So I think we're always concerned about, when you say what keeps us up at night, of course you have to worry about the left tail risks, but we're also very conscious of the right tail.
Thank you. Jan, what views are worrying you?
Yeah, we've thought a lot about what additional value we could be adding to the managers that we've partnered with, in addition to our capital. And over time, we've tried to be more flexible. That's one thing in terms of creating different structures for investing. But often we found that for smaller managers in particular, especially if they're starting with less than 100 million, it's really tough to get going, especially if they have to build out all the operations themselves and hire a full investment team, as well as be able to pass operational due diligence, from institutional investors. And so what we've done more recently to address that issue is we've partnered with an infrastructure provider called InnoCap, where they are able to provide fully outsourced non-investment functions to the smaller managers that we work with, including full back and middle office operations, legal compliance. And we think that's really decreased the moat, so to speak, in terms of people's ability to launch a fund, at a very small size, and do so effectively, and still have upside to a lot of capital from us and other investors if things go well. So that's one thing that we've done to kind of also fight back against the platforms in a way, and kind of lower the hurdle for people pursuing new businesses.
As a military man, I'm really disappointed you've not mentioned Taiwan or North Korea. So, is that a worry for you? I mean, just a quick 10-second opinion, Mike. Because that you could take days to discuss this sector.
A lot of the loudest voices on Taiwan are people directly connected to the military-industrial complex. So I tend to be a little bit skeptical of these Armageddon forecasts. I think the 1996 Taiwan Straits crisis was scary. I remember it. I was in college. If you've been looking at it for this long, maybe you're at risk of becoming complacent. I just think, in Canada, where I'm from, we don't always get along between the English side and the French side, but we're all Canadians. We're not certainly going to have a civil war. And I tend to look at it in similar terms, having lived in Shanghai myself and seeing the number of Taiwanese that actually live in mainland China full time and have business interests on both sides. It seems unlikely, and I just really hope everyone can kind of appreciate the face issues on both sides. You never want to like back someone against a wall where their dignity is at risk and they're forced to do something. But I'm pretty hopeful, and I think, look, we've had a great 70-year run of fairly peaceful world conditions, and the last 24 months have been different, and it hasn't really felt great to anybody. So hopefully with this experience, it's a bit of a reminder that we need to cooperate rather than focusing so much on competing.
Who would have thought 40 minutes could just fly by so quickly?
Yeah.
I'd like to thank the panel for your insights and the color. I mean, you've certainly given me lots of food for thought and to process, so thank you very much. And thank you all, too, for joining us at SALT iConnections. And if this is your first time with iConnections, I do wish you a productive and successful couple of days. And for the veterans amongst you who are returning, thank you so much for your support. And we look forward to seeing you all in Miami and in Singapore next year. All it leaves for me to say is thank you to the panel. I really appreciate your time.